configurator on the website. These changes are all live, and you can do some fun things like you can choose the fund family, go down to the best in class ETFs, and this will show you all of the different portfolios that we have using the best in class ETFs and their average expense ratio, which is 0.24%. And you can compare that to, say, Vanguard. And when you compare, what you see is that Vanguard is a little bit bigger and a little bit less value-y at 0.09% expense ratio and a little bit cheaper, right? You can do the same thing with Fidelity. You can look at Schwab. You can look at T. Rowe Price. They're the most expensive and least value-y. And you can also look at the Vanguard mutual funds. So you can play around with that, and then you can pick your portfolio. Let's say you do ultimate buy and hold 50/50 US in a tax deferred account, and it'll bring up all of the funds that you would use and the percentages you would use to achieve that particular allocation. And if you change the fixed income percent, it'll bring in the fixed income and give you all of those calculations as well.
And one of the things we talked about in one of our meetings was the the recommendations that are coming out of people like Wealthfront and Betterment. And our goal is to put as much money in the people who follow our work in their pocket as possible. And I suspect that many of the funds or ETFs that they are recommending are in some of those tables you're building, except that what they're recommending has a much lower or somewhat lower expected return. I think that's something that uh, would be important to people because, boy, wouldn't it be nice if you just could throw your money into Betterment, pay them a quarter of 1% or whatever it is they charge for larger accounts. I think to some point they're free, but you are going to get what they consider to be the best ETF in those asset classes. And my question is, are they the best? Well, the only person I have to compare to is what they have chosen and what you have chosen, Chris.
Yeah,
And
so yeah, I just pulled up the Wealthfront one, their classic portfolio, and they lean pretty heavily towards Vanguard. So they've got VTI for US stocks, they've got VEA for foreign developed stocks, VWO for emerging market stocks, and then you're into the bonds. And so I think I don't have any insights. I don't know how they make their choices, but I suspect that when it comes to compliance and somebody says, you have to do something that's in the best interest of your client, and you say, I chose the cheapest fund, that probably carries some weight. I also know, though, that when years ago I worked with a fiduciary DFA advisor, that they basically chose their funds based on the process I just described. That they used exactly the same process of a factor predicted expected return. And they have a similar duty of care. They have to do what's in the best interest of their client. So, which of those two do I believe? Obviously, I believe in applying the factors and the science and doing the math over just using the cheapest fund. Yeah.
so what you shared with us regarding small cap blend, do you also share with us the the tables that represent other of those asset classes?
I don't.
Okay.
And the reason I don't is that as Daryl described it earlier, there's kind of sausage making, right? And so it took a little while to clean that particular spreadsheet up for presentation and make it pretty so that it
Got it.
would post nicely on the website. But as you might expect, when you're in the middle of doing all this recommendations, there's a mess.
Yeah, I
You
got
make
it.
a mess,
Yeah.
and so I didn't take the time to clean up every one of my messes and share it. Yeah.
So another question that comes to mind is you talked about how Avantis did compared to other funds over a relatively short period of time. Um, and yet the work about these factors go back for decades. It's really whether somebody has been managing this way for a year. If you look like a certain kind of combination of factors, your return should be similar depending upon expenses, I'm guessing. But in some cases over the last years, I know I looked recently at the Russell 2000 fund at Vanguard over a 5 year period has made about less than half what AVUV had made. And so we're in this period where there evidently was a huge advantage to profitability because I'm guessing that's the weakness of Russell 2000 value is that they pay no attention to the quality of the companies. I shouldn't say they pay no attention, but they certainly don't pay as much attention as Avantis does. Um, how does that factor into your decision? What might be a big advantage to Avantis because of a relatively short period of time?
Well, I'd like to use the longest period of time I can. I use 3 years for my regression analysis because it's kind of a little bit of a compromise. It lets me get some of the newer or more recent funds, and then as you can see on the chart where I don't have where I have a fund that has a shorter history, I rerun the analysis for that shorter period of time across its peers so that I have apples to apples comparison. But what what gets captured in the analysis that I think might explain, for example, the Russell 2000 index underperformance is the negative alpha. And the reason I bring up negative alpha is that one of the advantages an Avantis or a DFA have over a straight index fund is that although they manage it much like an index, they don't have to tell the world the changes they're going to make ahead of time. They don't have to telegraph that on this date I'm going to have to trade out of or trade into something. And there's research that says the public published indexes pay a tax for that transparency, that they do get front run and they do have to buy new assets when they rebalance at a disadvantage. And that shows up in the negative alpha. And that gets included in the analysis. And it's part of the reason that some of these proprietary indexed funds, that's the way I like to think of DFA and Avantis, why they tend to have positive alpha or zero alpha is that they're not having to pay that tax.
So one other question I know is in the minds of a lot of our followers um, is this overweighting to Avantis, which you've already addressed. What does give me a sense of comfort is that when I look at the returns well, for example, the best performing small cap long-term performance has come from dimensional funds, DFFVX. And I've talked about it recently in a podcast over the last 25 years. It has doubled the return of the S&P 500, and it's done even better than that of the Fidelity Select Technology Fund, which has had supposedly a great record in the technology market. So it has done what small cap value was supposed to do over this last 25-year period. When I look at the work of Avantis and DFA, ever since Avantis came on the scene, the returns of Avantis and DFA, they're not the same. In many cases, there's a small advantage to Avantis, and in one case, there was a small advantage to DFA. But these are both organizations that are managing their money strictly by the books. As a matter of fact, this kind of a fund, people will say, well, that's not an index fund because they're trading things, they're making changes. It's an actively managed fund. Well, the minute you say that, so is the S&P 500 an actively managed fund, because once a year they take about 20 companies on average off the list and they add 20. So there's movement going on there as well. But the moves they're making, because their returns are, I mean, they are competitors. They want to beat each other, but their returns, because they come from the same academic background, are about the same. So I really have a sense that when I see that money that my wife and I have given to our 2-year-old granddaughter to hold for the next 90 years, I really believe that is a fund family as well as DFA that will continue to manage money in that way. How the world will end up, I have no idea. But I do believe that that's a stable way of managing money. Do you have any additional comment to make about that?
Well, the people at Avantis, as you well know, came from DFA, many of the people who started the company. And I think part of the reason Avantis was formed was that DFA did not have ETFs. And Avantis came to do that, to pioneer this kind of investing methodology. Both DFA and Avantis are deeply rooted in the work of Fama and French and in evidence-based, rational, academic investing principles. Um, Avantis likes to emphasize the business story a little bit more, which I like. They like to emphasize that, companies with good financials have historically done better, and so it makes sense to disproportionately weight them in the portfolio, and that is a subtle difference, but it's not a fundamental difference because the profitability factor came out of Fama and French's work too. So
Yeah.
yeah, it's not surprising to me that Avantis is doing really, really well in the ETF space because they're the first ones to pioneer a methodology consistent with our portfolios in that space. Go ahead, Daryl.
Yeah. I like to think of Avantis and DFA as cousins,
Hmm.
right? They have basically the same, they're not identical, but they have the same roots.
Yes.
And so they're very similar and they, it's kind of a DFA used to be hard to get a hold of too. You had to go to an advisor.
Right.
Whereas now you don't have to do that with Avantis.
And that may have been part of the reason they were reluctant to embrace ETFs, because once you embrace ETFs, you lose that hold on the relationship with an advisor. And, there was some, I think, customer-oriented, benefit-oriented reason for DFA to want to make their investors use an advisor. It wasn't selfish. I think it was that they knew that these investment approaches can sometimes go through long periods of underperformance, and you want an advisor there to educate the investor and help them understand that when you're at the bottom of that underperformance, you have paid for the return already. Don't get out now because the return is in the future. And so the advisor was serving a purpose for the investor to help them stay the course, and also for